Good morning, my dear children. So, previous class we started admission of a partner, and under admission of a partner, we have seen the first step in its accounting treatment, that is change in profit sharing ratio. There we have discussed that sacrificing ratio is equal to old share minus new share, which means whenever a new partner comes and joins the business firm, he gets his share of profit from the other old partners. In other words, the old partner sacrifices, and therefore there is a concept of sacrificing ratio. Now, the purpose for which the sacrificing ratio is calculated, or we can say the objective of calculating sacrificing ratio, is applied for the second step, which is called accounting treatment of goodwill. Whenever a new partner is admitted, he has to compensate the sacrificing partners, that means those old partners who sacrifices at the time of admission of a new partner. So new partner has to compensate the sacrificing partners for the sacrifice made by them in favor of the new partner. And this sacrifice of the sacrificing partners is compensated by the new partner by bringing an amount which is known as premium for goodwill. I repeat, premium for goodwill. Generally, when a new partner is admitted in any partnership firm, he brings with himself two things. One is his own capital. Second is known as premium for goodwill. So there are different cases for the treatment of premium for goodwill, which we are going to see in the second step at the time of admission of a new partner. So let's start. Accounting treatment of premium for goodwill at the time of admission of a partner. There can be following 5 situations relating to accounting treatment of the treatment of goodwill at the time of admission of a partner. Or we can say that there are 6 different cases in which goodwill can be treated. Children, it's written 5 here, but the number listed here is 6. Actually, it is 5 only, but there is one situation which is a combination of two situations. So I'll tell you. So please ignore this word 5 or 6. Let us go into the first case for the treatment of premium for goodwill. The first case says premium for goodwill is paid privately. That means when a new partner comes, he pays the goodwill, or more specifically premium for goodwill, to the sacrificing partners privately. Second says premium for goodwill is brought in cash or by check by the new or incoming partner, and it is retained in the business. Third, premium for goodwill is brought in cash or by check by the new partner, and it is withdrawn by the sacrificing partners fully or partly. Then the next case says premium for goodwill is brought in kind. Kind means not in cash but in the form of assets. Then fifth situation says when a part of premium for goodwill is brought. So this is actually the second case, which is brought in cash, and the sixth case when new partner does not bring his share of goodwill in cash. So it's a midway. So both these situations will be applied in number 5 when a premium is brought partly by the new partner. And here is the last one, sixth, when a new partner does not bring his share of goodwill in cash. So these are the cases listed. Now we will go into these cases one by one. So we move with the first case for the treatment of premium for goodwill, which is premium for goodwill is paid privately. And let us go into this first situation. Alright, so here it says premium for goodwill is paid privately. When premium for goodwill is paid privately, that is outside the business, by the new or incoming partner to the sacrificing partners, there is no accounting treatment. So it's very simple to understand that under this case, there is no accounting treatment. Therefore, no journal entry is passed in the books of account. We are not supposed to show it or record it in the books of account. So no accounting treatment is the answer in this first case for the treatment of premium for goodwill, which is paid privately by the new partner to the sacrificing partners. Clear? Case number 2. Case 2 says premium for goodwill is brought in cash or by check. So whichever way he brings, either by cash or by check, by the new or incoming partner, and this is retained in business. This word is important, children. Retained. Retained means that premium for goodwill money is kept in the business and utilized for the business purpose. So under this case, case 2, where the money is brought in cash and retained as well, there are entries. And here is entry number 1. Cash or bank account debit to premium for goodwill account. I repeat, cash or bank account debit to premium for goodwill account. Narration will go being premium brought in cash by the new partner. I hope this is clear. I told you that whenever a new partner comes, he brings with him two things. One is premium for goodwill, and what was the second thing? Second thing is his own capital. So for that the entry is cash or bank account debit to new partner's capital account. We can even make a compound entry for entry number 1 and 2, and if we make it a compound entry, this is the compound entry. Cash or bank account debit to new partner's capital account to premium for goodwill account. I hope you got this. Now, this premium which is brought by the new partner will now be distributed among the sacrificing partners in the sacrificing ratio. I repeat, this premium brought by the new partner is distributed among the sacrificing partners in the sacrificing ratio. Remember, we calculated sacrificing ratio in the first step of change in profit sharing ratio. So old partners, when they sacrifice their share, they get certain sacrificing ratio. So here is the utility of the goodwill, that this premium for goodwill brought by the new partner would be distributed among the sacrificing partners in the sacrificing ratio. So the entry is premium for goodwill account debit to sacrificing partners capital account, and if it is fixed capital method, it will be current account. In case of fluctuating capital, it will be partners capital account, and in case of fixed capital, it will be partners current account. So I will suggest you go for these two entry. The first one is for bringing capital and premium in cash, and second entry will be to distribute this premium among the sacrificing partners in their sacrificing ratio. And here the entry goes, the narration goes being premium credited to sacrificing partners in sacrificing ratio. I hope this is clear. Two entries, and which case we are discussing? We are discussing case number 2, when premium for goodwill is brought in cash and it is retained in the business. Now here is an example for case 2 where the premium is brought in cash and retained in the business, in the partnership firm. Children, before we move ahead with this example, let me make one thing very clear to you. See, goodwill is an asset. It is an intangible asset for a partnership firm or for any business. Goodwill is called an intangible asset. The reputation of the business, when it is expressed in monetary terms, is what we call the goodwill of the business or the goodwill of the partnership firm. Now, whenever you read the word goodwill, goodwill stands for the entire monetary value of the business firm. And the share of the new partner in the goodwill of the entire firm is known as premium for goodwill. And that too, when he brings that share of goodwill in cash, it is known as premium for goodwill. Now, suppose the share of the goodwill of the firm, if you see in this question, goodwill of the firm is valued at rupees 40,000, and there will be share of the new partner. So based on the share of the new partner, we will calculate premium for goodwill account. And I believe that A and B gives 1 by half of their respective shares to C. Okay, so that means the share of the new partner will be calculated by applying the information, and what I'm getting from here is that C's share is equal to 5 by 10 or 1 by 2. Okay, so the goodwill, which is 40,000 here in this question, goodwill of the firm is 40,000. So C's share in this goodwill 40,000, which is 1 by 2 here, will be 40,000 multiplied by 1 by 2, which is here goodwill brought by C. Can you see this? Goodwill brought by C, 1 by half of 40,000, which is equal to 20,000. So this 20,000 is premium for goodwill. So the question says there are two partners A and B. They are sharing profit and losses in the ratio of 3:2. They admit a new partner C. C brings his share of premium for goodwill in cash. See here, in cash. That means which case is this out of the two cases we have discussed? This is case 2. Goodwill of the firm is valued at 40,000. So we will have the entry for the premium for goodwill brought by the partner C. So the entry goes cash or bank account debit 20,000 to premium for goodwill account 20,000, being premium brought in cash by partner C. And which is the second entry? The second entry will be to distribute this premium for goodwill between the sacrificing partners A and B. So premium for goodwill account debit 20,000. It comes from here. This credit account is debited with the same amount 20,000, and sacrificing partners are credited to A's capital account to B's capital account in their sacrificing ratio. So you'll calculate sacrificing ratio. It is coming as 3:2. So 3 by 5 of 20,000 will be sacrificed by A. So he gets premium 12,000 out of 20, and 2 by 5 of 20,000 will be the share of premium which B gets from the partner C. So the distribution goes 12,000 and 8,000. In which ratio? In sacrificing ratio 3:2. So this is a good example to understand case number 2. I hope you have understood this. Okay. So having understood case 2, we move ahead with case 3, and it is just one step more than case 2. It's easy to understand now. It is just one additional step in case 3. Case 3 says when premium for goodwill is brought in cash by the new partner and it is withdrawn by sacrificing partners. This word is important. Withdrawn by sacrificing partners either fully or partly. That means the money which was retained in the previous case 2 is not retained in the business. It's not kept in the business. But here in case 3, it is withdrawn by the sacrificing partners. So if you remember in the previous case example, 12,000 was given to partner A and 8,000 was given to partner B, and that money 20,000 was retained in the business. So what will happen in this case, if the same example is taken, 12,000 and 8,000 will be withdrawn by the partner A and B from the business. They will take out that money. So under this case 3, when the money is withdrawn, first entry is same, which was there in case 2, cash or bank account debit to premium for goodwill account, being premium brought in cash. Second entry is also same, premium for goodwill account debit to sacrificing partners capital account, being premium credited to sacrificing partners in sacrificing ratio. Now there is another entry, which is third entry, for withdrawal of premium amount fully or partly. That entry goes sacrificing partners capital account debit to cash or bank account, being amount of premium for goodwill withdrawn by the sacrificing partners. So I repeat, there is third entry which says sacrificing partners capital account debit to cash or bank account, being amount of premium for goodwill withdrawn by the sacrificing partners. So one additional entry as compared to case 2 where there were two entries. First two entries stand same. First entry, second entry, and this is third entry. Hope this is clear. If you revise this, you will learn it in slow process when you do questions. So for the moment, you can take help and revise it. So let's give a quick look to case 3 example. And the question says, strong and weak are partners sharing profits in the ratio of 2:3. On 1st April 2020, they admit Able as a new partner for 1/4 share in profits. Able brought rupees 1 lakh as his capital and rupees 36,000 as premium for goodwill for his 1/4 share in the profits. New profit sharing ratio for strong, weak and able is given as 3:3:2. Strong and weak withdraw the premium for goodwill. So the moment you see this word withdraw, that means this is case 3, past necessary journal entries. Now, the first step in every question for treatment of goodwill should be to calculate sacrificing ratio. This we have already learned in step 1. So, you will calculate sacrificing ratio with the help of this old ratio 2:3 and the new ratio 3:3:2. Sacrificing ratio formula will be applied, and here in working notes, I guess the sacrificing ratio is also calculated, which you should do on your own. See here. Old share, new share, and sacrifice share. So the sacrificing ratio between strong and weak is coming as strong is to weak 1:9. 1:9. So this is the sacrificing ratio of strong and weak. So here, because this is case 3, we have to take the entries into account under case 3, and case 3 has how many entries? Yes, it is 3 entries. So first entry goes cash or bank account debit to Abel's capital account to premium for goodwill account. See, the question says he's bringing capital rupees 1 lakh. That is why capital account will be credited. Abel's capital account with 1 lakh. Then premium for goodwill account is credited with 36,000. Total money coming into the business is 1,36,000. Capital 1 lakh and 36,000 premium for goodwill. Being premium for goodwill and capital brought in cash. Second entry, premium for goodwill account debit with 36,000 to Strong's capital account to Weak's capital account, being premium for goodwill credited to sacrificing partners in sacrificing ratio 1:9. So 36,000 divided in sacrificing ratio 1:9 goes 3,600 for strong, and for weak it is 32,400. Children, this calculation you're not supposed to show here. This 36,000 into 1 by 10 and 9 by 10 you should show in working notes. Please avoid writing it here. It is from book. I've clicked it from book. So I'm telling you, do not write it here. Now there will be third entry because the partners are withdrawing the share of premium for goodwill. The third entry goes Strong's capital account debit with 3,600. Where is it coming from? It's coming from here, 3,600, 3,600. Then week's capital account debit, 32,400. It's coming from here to bank account or cash account, and the amount will be 36,000. Being premium amount withdrawn by sacrificing partners. And I've already shown you, you're working for the calculation of sacrificing ratio, which is highlighted here in the working notes. So this is a good example for case number 3. I hope this is understood. Please note down these cases and these examples in your copy serial wise. Do not bring anything in between it, because it should be listed and jolted in your copy so that you can revise it whenever you are revising it for test and exam purpose. Now here is case 4. When premium for goodwill is brought in kind. When premium for goodwill is brought in kind. In kind means in the form of assets, not in the form of cash. New or incoming partner may bring assets valued at amount equal to his share of premium for goodwill. In this situation, the assets brought are debited individually with their agreed values, and premium for goodwill account is credited. Thereafter, premium for goodwill account is transferred to capital accounts of the sacrificing partners in the sacrificing ratio. So here in this case, the new partner does not bring cash. Instead, he brings certain assets for his share of goodwill. So the first entry goes assets account debit to partner's capital account to premium for goodwill account. Capital account will be credited with the share of his capital brought in by the new partner, and premium for goodwill account will be credited with the share of premium for goodwill. And instead of cash, you will debit assets. If you have been given assets individually, you will write the name individually. If collectively asset word is used, you will write the word asset. And the next entry is this premium for goodwill will be debited and it will be distributed among the sacrificing partners in their sacrificing ratio, just like we have done in case 2 and 3. Premium for goodwill account debit to sacrificing partners capital account. I hope this is clear. Brought in kind, not in cash. So here is an example, and I'm not reading the question, but you can very well, pause your clip and read the question. I'm giving you the solution. Here is the solution. The new partner Z is bringing stock, debtors, land account, and plant and machinery account as 4 assets in the form of premium for goodwill account. So you will write their values individually: 80,000, 120, 2 lakh and 120. Then his capital account is credited with his capital 2 lakh 80,000, and premium for goodwill account is credited with his share of premium for goodwill 2 lakh 40,000. And in the next entry, this premium for goodwill account 2 lakh 40,000 is distributed among old partners X and Y. The entry goes premium for goodwill account debit to X capital account to Y's capital account, and this 2,40,000 is distributed in the sacrificing ratio 2,24,000 for X and Y 16,000. The working note shows Z's share of goodwill is equal to 10,40,000 into 3 by 13, which is equal to 2,40,000. So this premium was not directly given in the question, it has to be calculated, and here is the table for old share, new share, sacrificing share, and the sacrificing ratio between X and Y stands at 14:1, in which the premium for goodwill is credited among X and Y. So revise this example properly to understand and do the working for sacrificing ratio and the amount calculated on your own, so that you can understand how this has been arrived. These are all mathematical steps which should be done, which you should practice under the first step of accounting treatment at the time of admission of partner, that is change in profit sharing ratio. I hope this is clear. So we move ahead. It says when a part of premium for goodwill is brought in cash and the other part he is not able to bring in cash. So this is combination of case 2 which we discussed, and whatever he does not bring will be treated in his current account. Children, let me do one thing. Let me first explain you the last case 6, then you will understand this better. So I'm skipping this fifth case and moving with case 6. Here it is. When the new partner does not bring, this is important, does not bring his share of premium for goodwill. It's simple. When a new partner does not bring his share for premium in cash, we do not call the word premium. There is no premium for goodwill. It is there, but because it is not coming in cash, the entry is new partner's current account debit to sacrificing partner's capital account. I repeat, new partner's current account debit to sacrificing partner's capital account. In such a situation, there will be goodwill of the firm given to you in the question. From that goodwill of the firm, you will find the share of the new partner in the goodwill of the firm, and that amount will be debited to his current account. Remember, current account, not capital account. If suppose C is a new partner, you will write C's current account debit to A's capital account to B's capital account. Clear? I read the line. If the new partner does not bring his share of goodwill, then premium for goodwill is adjusted through current account of the new partner. And here is the entry. So it is now easy to remember. Whenever he does not bring, we have to open his current account on the debit side in the entry. And when he brings, we write cash account. So the previous case, we go back now, case number 5. Whatever is not brought will be to which account? Current account. Okay. And whatever he brings, that we have seen in case 2. So here is the entry. For amount brought by incoming partner, cash or bank account debit to incoming partner's capital account, that is new partner's capital account, to premium for goodwill account. I repeat, bank account debit to incoming partner's capital account or a new partner's capital account to premium for goodwill account, being premium premium and capital brought in cash by the new partner. So the same entry, and now we will have to distribute this premium among the sacrificing partners in the sacrificing ratio. So this premium for goodwill account is debited, what is bringing in cash, and what is not bringing in cash. For that we have seen we have to open current account. So new partners current account debit to sacrificing partners capital account, being premium and premium bought in cash and not brought debited to new partner's current account. So here is the combination of case 2 and case number 6 which we have discussed, which comes together here when a part of premium for goodwill is brought and the remaining is not brought in cash. Please ignore this first entry. We will discuss in the next class about goodwill written off. For the moment, ignore this entry. So here are all the cases for the treatment of premium for goodwill when brought in cash and when not brought in cash. I hope you have understood, and with this hope that you will revise this and note down all these entries with the examples in your copy. We end today's class. It is very important area, step 2, that means case 2, where the treatment of goodwill is done under different cases. So children, note it down in a copy. Please read it again and again to understand. Then you start learning when you do and apply it in the questions. There are exercise questions, but before that, please solve examples given in your book. And when we start the next class, we will go with the next topic, revaluation of assets and reassessment of liabilities. Before that, I will explain you this goodwill which is written off in the next class. So take care, keep practicing, keep studying, and work hard. Thank you.